What if I told you that being hundreds of thousands of dollars in debt is the single greatest wealth-building strategy in American history?
I mean, it sounds completely counterintuitive.
Right. Seriously, just think about that for a second. We spend our entire lives being told to avoid debt. You know, pay off your credit cards.
Yeah, cut them up.
Don't finance a car you can't afford. We're taught that debt is a trap. Like, debt is how the system keeps you down.
Which is true for a lot of things.
It is, and yet there is this one specific type of debt, a massive, decades-long, six-figure liability that operates almost like a financial cheat code.
Yeah, a total cheat code.
And it isn't cryptocurrency. It isn't some complex algorithmic day trading strategy or whatever.
Right.
It isn't artificial intelligence, and it is definitely not the stock market. Today, we're unpacking a financial trick so massive, so universally accepted, that it literally built the American suburbs.
It really did.
It funded the middle class. And for this deep dive, we're looking at a bunch of sources that break down something so, well, mundane, that most people don't even think of it as a financial instrument.
No, they just think of it as a monthly chore.
A bill.
Yeah. Exactly. We're talking about the 30-year fixed-rate residential mortgage.
At the 30-year fixed.
But I'm coming into this with a massive dose of skepticism. Because, you know, if you look at the reality of everyday life, most people I know feel suffocated by their mortgage.
Oh, for sure.
They look at this thing as a giant anvil hanging over their head for 30 years. You sit at a desk, you sign a stack of papers an inch thick, you hand over your life savings.
And then you're trapped.
Yeah. You spend the prime decades of your adult life sending a massive chunk of your paycheck to a bank. And most people do this without ever really understanding the underlying mechanics of what that contract is actually doing to their net worth.
Yeah, they just look at the monthly payment. Right. So to call a 30-year, six-figure debt a trick to building wealth, I mean, that requires some serious explaining. How do we distinguish this from the kind of debt that bankrupts people?
Well, the distinction really lies in what the debt is actually attached to and the environment in which you pay it back.
Okay.
Because not all debt behaves the same way in the broader economy. If you want to understand the trick here, you have to look at consumer debt versus mortgage debt.
Like credit cards versus a house.
Yeah, or take a car loan, for example.
Yeah.
You borrow $40,000 to buy a new car. The second you drive that car off the dealership lot,
It loses like 20% of its value.
right, 10 to 20% instantly, you are paying interest on an asset that is actively, aggressively depreciating.
Just burning money.
Pretty much. By the time you pay off the car is worth a fraction of what you paid for it. The debt basically outlived the value of the asset.
So you're fighting a losing battle against depreciation from day one. You're paying a premium for something that is slowly becoming worthless.
Yeah, but precisely the opposite happens with a mortgage. You are financing real estate.
Which usually goes up.
Right. Historically, over long time horizons, real estate is an appreciating asset. So you're borrowing money to control an asset that is statistically likely to be worth more in the future than it is today.
Okay, that makes sense.
But that is really only half of the equation. The second half, the part that makes the 30-year fixed-rate mortgage uniquely powerful, is how you pay the debt back.
How do you mean?
You are allowed to repay this massive loan using future income that is gradually, invisibly eroded by inflation.
Wait, eroded by inflation? Because usually we talk about inflation as the enemy, right?
Oh yeah, usually it is.
It's like inflation makes groceries more expensive, it makes gas more expensive. You are saying inflation is the secret weapon here.
It is. For the borrower holding fixed-rate debt, moderate inflation is an incredible tailwind.
Oh.
You are essentially paying off a loan from the past using the cheaper, inflated dollars of the future. The bank is locked in. They cannot ask you for more money just because inflation went up.
It sounds almost like a glitch in the matrix when you lay it out like that. Financing an asset that goes up using money that goes down in value.
Yeah, it's wild.
But to truly wrap our heads around why this was such a revolutionary invention, I want to step into a time machine for a second, because this system didn't always exist.
No, not at all.
I am trying to picture, like, my great-grandparents trying to buy a house in, say, 1935 or 1940. If they couldn't just open an app and get pre-approved for a 30-year fixed loan, what exactly did the local bank hand them?
Well, if we look at the baseline data from the early 20th century leading up to 1940, the American housing market was a completely alien landscape.
Oh, so.
Owning a home was not the default American dream for the working class. It was a rare privilege reserved almost exclusively for the wealthy.
Really? Just for the rich?
Yeah. The homeownership rate in the United States hovered at less than 44%.
Wow. So well over half the country was renting or living in multi-generational housing. They were just locked out of ownership.
They were locked out by the sheer brutality of the lending terms.
The terms were that bad.
Oh yeah. Before the modern mortgage was invented, if a family wanted to buy a home, the bank required an enormous sum of cash up front. Typically a 50% down payment.
50%. Okay, let's just ground that in today's numbers to see how absurd that is.
It's crazy.
If I want to buy a starter home in a decent market right now, maybe it costs $400,000. A 50% down payment means I need to walk into the bank with $200,000 in liquid cash.
Right. Just sitting in a briefcase.
Which instantly eliminates the vast majority of the population. A factory worker in 1930 could save for 2 lifetimes and never hit that threshold.
Never. But the terms of the loan itself were even more restrictive than the down payment.
Wait, it gets worse.
Yeah. If you somehow managed to scrape together the 50% down, the bank would only lend you the remaining money for a term of 5 to 10 years.
5 to 10 years to pay off half a house? The monthly payments must have been completely unmanageable for a normal salary.
They were. And here is the kicker. In many cases, these loans were not fully amortizing.
Meaning what?
Meaning your monthly payments didn't even pay off the debt.
Yeah.
You were often just paying the interest for 5 years.
Oh my God.
And then, at the end of that 5-year term, the entire remaining balance of the principal came due on a single day. This was known as a balloon payment.
A balloon payment. So I pay my monthly interest for 5 years, I get to year 5, and the bank knocks on my door and says, okay, we need the other $200,000 right now, in full.
That is the reality they lived with. Now, the expectation was never that the homeowner would actually have the cash to pay the balloon payment.
Then what did they do?
The unspoken agreement was that when year 5 rolled around, you would simply walk back into the local bank, shake hands with the banker, and refinance that balloon payment into a brand new 5-year loan.
Ah.
You would just constantly roll the debt over, half a decade at a time.
I'm trying to put myself in the shoes of a local bank manager in that era. Why were they so incredibly stingy?
Well, they had to be.
Because a 50% down payment and a 5-year leash feels like the bank is terrified of the borrower. They clearly did not want to hand this money out.
The banks were terrified, and for good reason. From a banking perspective, real estate was considered one of the absolute riskiest assets you could possibly lend against.
Really? Riskier than a business loan?
Yeah, think about the nature of a house. It is highly illiquid. You cannot sell a house in an afternoon if you need cash.
Right.
Furthermore, a house is permanently tied to the economic health of its specific immediate location. If the local mill closes down or the local mine dries up, the borrower loses their job and defaults.
And then the bank gets the house.
Right. The bank is stuck taking ownership of a house in a town where no one has a job, meaning the bank cannot sell the house to recover its money.
I see. So the bank demands a 50% down payment to create a massive margin of safety. If they have to foreclose and sell the house at a steep discount, they still get their money back. And they want 5-year terms so their money isn't tied up for generations.
It was a highly defensive posture. The banking system was protecting its own liquidity at the expense of the consumer's ability to buy.
Wow.
And this highly fragile system simply chugged along, servicing the wealthy elite, until it encountered the ultimate stress test.
The Great Depression.
The Great Depression.
This is the historical catalyst, the breaking point.
Yeah, the Depression completely shattered this short-term balloon payment system. It exposed the structural flaw of relying on constant refinancing.
Right, because nobody had money to refinance.
Well, when the stock market crashed and the economy collapsed, banks began experiencing runs. Depositors demanded their cash.
So the banks were bleeding liquidity.
Exactly. So when a homeowner reached year 5 of their mortgage and walked into the bank to refinance their balloon payment,
the banker looks at them and says, I'm sorry, we don't have any money to lend you. We aren't refinancing anyone. We need that balloon payment in full. Today.
Yeah, and because the homeowner obviously didn't have the cash, especially during the Depression, the bank had no choice but to foreclose.
That's horrifying.
The scale of the catastrophe is hard to comprehend today. At the darkest depths of the crisis, roughly 1,000 homes were being foreclosed on every single day in America.
1,000 families losing their homes every 24 hours.
Every single day.
The social devastation must have been apocalyptic.
Mass evictions, families out on the street, boarded up neighborhoods, And ironically, the bank's defensive strategy destroyed the banks themselves.
Because now they just own a bunch of empty houses.
Right. Their balance sheets were suddenly bloated with thousands of empty, depreciating houses that they couldn't sell instead of performing loans that paid interest. The entire American banking system was seizing up. It became blindingly obvious to economists and the government that the system didn't just need a temporary bailout. The fundamental architecture of housing finance required a radical invention.
Which brings us out of the historical wreckage and into the modern mathematical solution, the invention that changed everything.
The 30-year fixed.
Yeah. I want to look at the actual math of the 30-year fixed-rate mortgage because the sources provide a very clear modern scenario. Let's walk through this carefully.
Okay, so let's do it.
Imagine a family today buying a $400,000 home. They put down 20%, which is $80,000. That means they are asking the bank for a loan of $320,000.
A very standard conventional loan profile in the modern era.
Right, so let's assume they lock in a fixed interest rate of 6% over a 30-year term. The monthly payment, just calculating the principal and interest, leaving out taxes and insurance for a moment, comes out to $1,919.
$1,919 a month for 360 consecutive months.
Now, if I am a skeptic sitting at the kitchen table with a calculator, I am going to run the lifetime cost of this deal.
And it's going to look scary.
It really is. If I pay $1,919 every month for 30 years, by the time I make that final payment, I will have handed the bank roughly $690,000.
The math checks out.
I borrowed $320,000. I am paying back $690,000. That means $370,000 of that total is pure interest.
Pure interest, yep.
I am paying more in interest than the original sticker price of the loan. I mean, if a friend came to me with this business proposal, I would tell them they were being scammed.
I would too.
How does any financial advisor look a family in the eye and say, yes, paying more in interest than the value of the home is a brilliant strategy for building wealth? It sounds predatory.
If you look exclusively at the aggregate lifetime numbers, it does sound completely predatory. But those aggregate numbers hide the secret engine of the mortgage. The secret lies in the internal structure of the loan. It lies in the mathematics of amortization.
Amortization, it's one of those financial words that sounds intimidating, but the root of the word is mort, right? Like mortality, death.
Yeah, the slow, scheduled killing off of a debt.
So exactly how does this debt die? Because I think most people harbor a very persistent myth about their mortgage payments.
What's the myth?
The assumption is that if I send the bank my $1,900, it gets chopped in half. Half pays down my debt, and half goes into the bank's profit bucket.
Oh man, that is the most common misconception in personal finance. The payments are absolutely not divided evenly.
Not even close, right?
Not even close. Let's dissect that very first payment. Month 1 of year 1. You write the check for $1,919 and send it to the bank.
Yeah.
Out of that total, about $1,600 goes straight toward paying the interest.
$1,600. Poof. Gone.
Leaving a mere $320 to actually reduce the principal balance of your $320,000 loan.
That's depressing.
The bank is extracting its profit aggressively up front. You are building equity at a painfully slow crawl in the beginning.
I mean, I am sending the bank nearly $2,000, and my actual ownership of the house only increases by $300. I feel like I'm running on a treadmill and going nowhere.
It does feel like that.
Why is it structured so violently in favor of the bank in the early years?
It is entirely about risk mitigation for the lender. When a bank lends you hundreds of thousands of dollars for 3 decades, they are taking on massive uncertainty.
Right.
Statistically speaking, the highest probability of a borrower defaulting on a mortgage is concentrated in the first few years of the loan.
That makes intuitive sense, because if a major life shock is going to derail you, a divorce, a sudden medical crisis, a layoff, it is most dangerous before you've had time to build up savings or before your career has advanced to higher earning brackets.
Yeah, exactly. Furthermore, in the first few years, the borrower has the least amount of skin in the game.
Because their equity is lowest.
Right, meaning they're more likely to walk away if things get tough. So the bank designs the amortization schedule as a defensive shield.
Protect the house, basically.
Protect the bank. By front-loading the interest, the bank extracts the bulk of its required yield during the period when the risk of default is at its absolute peak. They're making sure they get paid first, while the risk is highest.
It feels incredibly punishing for the person writing the check.
It is punishing initially, But amortization is a mathematical curve. If we track this over time, we eventually reach a tipping point.
Okay, when does it get better?
Imagine a teeter-totter. In year one, the heavy side is entirely resting on the interest. But every single month, that tiny $300 principal payment slightly reduces the total amount you owe.
Just chipping away at it.
Just chipping away. And because your interest is calculated on a slightly smaller balance the next month, the interest charge drops by a fraction of a cent.
And since my total payment is fixed at $1,900, any drop in the interest charge means a few more pennies shift over to paying down the principal.
Yeah. Slowly, month by month, the teeter-totter shifts.
Okay.
By year 15 of a 30-year mortgage, something remarkable happens. The principal balance has fallen substantially enough that the interest cost is significantly lower. The teeter-totter levels out.
So 15 years in.
Yes. And as you cross into the final third of the loan's life, the relationship completely inverts.
So if I look at my statement in, let's say, year 28.
In year 28, nearly the entire $1,900 payment is going directly into your principal equity. You are paying absolute pennies in interest to the bank.
Wow.
This gradual, accelerating shift is the magic of the amortization curve. It protects the lender on the front end, but it geometrically rewards the borrower who has the discipline to stay the course on the back end.
Here is where I still struggle, though. Even knowing that the math flips in my favor at year 15, 15 years is an eternity in human life.
It is a long time.
That is a massive chunk of a career. To wait just to start making a real dent in the principal. Why would any rational borrower willingly sign up for a 30-year timeline if those early years are so deeply inefficient for building equity?
Because the true genius of the 30-year mortgage isn't the amortization schedule.
It's not.
No, the amortization curve is just the mechanical plumbing of the loan. The actual magic trick, the force that generates the wealth, is time.
Time fundamentally alters the value of money.
It does. Let's explore the dynamic relationship between time and inflation. This is the core reason why the 30-year timeline works so heavily to the borrower's advantage.
Walk me through it.
The source material provides a fantastic illustration using the year 1995. Let's say a buyer purchased a home in 1995 and locked in a fixed monthly mortgage payment of $900.
Okay, in 1995, $900 was a very serious monthly commitment. That took a massive bite out of a middle-class paycheck.
It did. But fast forward to today, if they have not refinanced, their monthly payment is still exactly $900.
Still $900.
The contract is fixed. The bank cannot demand a single penny more. However, over that same 30-year period, the median household income in the United States has more than doubled.
Oh, man. So the payment stayed frozen in amber, but the paycheck going into the homeowner's stroke account got significantly larger.
This is the economic engine of inflation at work. Inflation relentlessly, steadily reduces the purchasing power of every single dollar in circulation.
Right.
A dollar today buys significantly less milk, less gas, and less labor than a dollar did in 1995. But here is the critical concept.
What's that?
Your mortgage debt is denominated in fixed nominal dollars. You do not owe the bank purchasing power. You owe the bank a specific, unchanging quantity of dollars.
I see. So as my salary naturally adjusts upward over the decades to keep pace with the rising cost of living, that frozen $900 mortgage payment feels lighter and lighter.
Exactly.
It goes from being, say, 30% of my take-home pay to maybe 10% of my take-home pay.
The borrower is effectively executing a long-term arbitrage. The bank lent you highly valuable, high purchasing power dollars in 1995. You use them to buy a physical asset.
A house.
A house. And then decades later, you are paying the bank back with dollars that are worth vastly less.
That's brilliant.
The 30-year fixed-rate mortgage is one of the only financial instruments available to the public where moderate, persistent inflation actively transfers wealth from the institution to the individual.
It is basically a slow-motion wealth transfer facilitated by the Federal Reserve's inflation targets. The bank is just eating the loss in purchasing power.
Well, the banks understand this, of course.
Right, they're not stupid.
No. They charge interest to compensate for that anticipated loss of purchasing power over time, and they rely on the law of large numbers across millions of pooled mortgages. But from the perspective of the individual family, locking in a static housing cost against a rising nominal income is an incredibly powerful financial advantage.
Okay, I follow the logic on inflation. That's super clear. But let me ask a practical question about the term length itself.
Sure. We established that 30 years gives inflation plenty of time to erode the debt. But why did 30 years become the universal standard? Why not a 15-year fixed rate
Yeah.
or a 40-year fixed rate?
That's an interesting point.
Because if time is the secret ingredient, why not a 50-year mortgage?
It comes down to a very precise calculation regarding monthly affordability. The system was designed to optimize market entry, not wealth maximization.
Market entry, getting people in the door.
Yes. Let's return to our data point, the $320,000 loan at 6%. On a 30-year term, the monthly payment is roughly $1,900.
Right.
Now, if we take that exact same loan amount at the same interest rate and condense the repayment schedule into a 15-year term, the math changes violently.
What does the payment become?
A 15-year mortgage on that balance requires a monthly payment of roughly $2,700.
Wow, $2,700.
Heh.
Compared to $1,900, that is nearly an $800 difference in cash flow every single month. Mathematically, the 15-year loan is a vastly superior wealth generation tool.
Because you pay so much less interest.
Right. You pay substantially less aggregate interest over the life of the loan, and you own the asset free and clear in half the time. But that $800 monthly delta is the barrier to entry. The 30-year term was engineered to shrink the monthly obligation down to a level that the median wage earner could stomach.
Because an $800 lower payment means a family with a much lower income can suddenly qualify for the underwriter's debt-to-income ratios.
Affordability is the lever that creates massive market demand. By stretching the repayment over 3 full decades, the financial industry brought millions of middle-class and working-class families into the housing market who would otherwise be entirely priced out of homeownership.
But this brings up a massive, glaring systemic problem. If I am the manager of the local town bank, and I am lending you $320,000, and I have to wait 30 years to get my principal back, A&D inflation is slowly eating away the value of the money you are eventually returning to me. Why on earth would I agree to this?
Wow.
Like, if I lend out all the cash in my vault to 50 families in my town, I am out of money for 3 decades. I can't write any more loans. My business is frozen.
You have just identified the exact liquidity trap that paralyzed the banking sector during the 1930s.
Oh, really?
Yeah, it is structurally impossible for a local bank to originate 30-year loans and hold them on its own balance sheet while relying on the short-term deposits of its savings account customers.
That makes total sense.
It is a massive duration mismatch. If the depositors come in on a Tuesday and want their money back, the bank cannot suddenly sell 50 houses to pay them.
So how do we solve the bank's liquidity problem? Because obviously banks today hand out 30-year loans like candy.
The solution required massive, unprecedented government intervention, born directly out of the ashes of the Great Depression.
Okay.
The federal government realized that to save the housing market, they had to solve the bank's liquidity crisis. The first step was the creation of the Federal Housing Administration, the FHA, in 1934.
What did the FHA do?
The FHA standardized the concept of the long-term loan and offered government insurance on them.
They basically told the nervous local bankers, if you write these long-term loans with lower down payments, the federal government will backstop you. If the borrower defaults, we will cover the loss.
Right. Insurance mitigated the risk of default, but it didn't solve the cash shortage. The banks still needed actual liquid capital to keep lending.
So they needed cash.
So in 1938, the government introduced the master stroke, the creation of the Federal National Mortgage Association.
Better known today as Fannie Mae.
Fannie Mae. They introduced the secondary market mechanism, and its brilliance lies in its simplicity.
Walk me through it.
Here is how it functions. Instead of your local bank lending you $300,000 and then waiting patiently for 30 years to recover its capital month by month, the bank originates the loan, has you sign the papers, and then immediately turns around and sells that mortgage contract to Fannie Mae.
Wait, let me make sure I'm visualizing this correctly. I go to my local bank on Main Street. They approve me. I buy the house.
Yep.
Behind the scenes, the local bank packages my loan documents, sells them to Fannie Mae, and Fannie Mae hands the local bank $300,000 in crisp cash.
The local bank gets its underlying capital replenished almost instantly, plus they earn a small origination fee for doing the paperwork and finding the borrower.
Okay, wow.
Because their vault is immediately refilled by Fannie Mae, the local bank can turn around the very next morning and lend that exact same $300,000 to another family down the street, and then they sell that loan to Fannie Mae.
So one single dollar of bank capital can now finance multiple generations of home buyers in rapid succession. It is a perpetual motion machine for lending.
It transformed the entire financial architecture of the United States. Mortgages ceased to be localized products constrained by the deposits of a single town.
They became nationally traded liquid assets.
Yes, this secondary market was later expanded in 1970 with the creation of Freddie Mac to introduce competition. Together, Fannie Mae and Freddie Mac provided the infinite well of liquidity required to make the 30-year mortgage viable for lenders.
And how big is this market today?
This mechanism is what built today's U.S. residential mortgage market, an entity that now exceeds $13 trillion in size.
$13 trillion, my God. When you suddenly unlock that kind of infinite capital and you make it available to average working-class citizens through low 30-year monthly payments, that has to radically alter the physical and social fabric of the country.
Oh, completely.
What actually happened when this floodgate of capital opened up?
The most visible, immediate consequence was a financing revolution that physically redrew the map of America. Following the end of World War II, the country experienced an unprecedented demographic and economic boom.
The baby boom.
Right. Millions of returning soldiers were entering the civilian economy. Thanks to the GI Bill, they were granted access to these newly standardized, government-backed long-term mortgages with incredibly favorable terms.
What kind of terms?
Often requiring effectively zero down payment.
Wow. So you have millions of young men returning from Europe and the Pacific. They want to get married, they want to start families, and suddenly the government and the banking system are standing there saying, we will give you 30 years to pay off a house, and you barely need any money up front.
The result was the explosive birth of the American suburb. Real estate developers looked at this infinite pool of finance buyers and realized that if mortgage money was universally available, they could apply Henry Ford's mass production techniques to housing.
Assembly line houses.
Exactly. Developers bought up massive tracts of cheap farmland outside major cities. In places like Levittown, New York, they created standardized assembly line construction processes.
Right, where every house kind of looks the same.
Yeah. They demonstrated that if you paired highly efficient building techniques with long-term 30-year financing, you could conjure entirely new, sprawling communities out of thin air in a matter of months.
It's fascinating because culturally, we usually credit the automobile or the interstate highway system for the creation of suburbia. We think of cars allowing people to commute.
Cars and highways provided the logistical connection to the city centers, undoubtedly. But the mortgage provided the capital that actually built the houses.
Without the 30-year fixed-rate loan, the demand doesn't exist and there is no Levittown.
The impact on society was staggering. Between 1940 and 1960, driven almost entirely by this financial innovation, the U.S. homeownership rate surged from that baseline of roughly 44% to over 60%.
That's a massive jump.
The American suburb is often studied as an architectural or sociological movement, but at its very core, it was a byproduct of financial engineering.
And as millions of families migrated into these new suburbs and started making their monthly payments, they triggered another massive hidden consequence. I want to look at the psychology of wealth for a moment, because this is where human behavior collides with financial products. Let's be honest, generally speaking, human beings are terrible at saving money voluntarily.
We are exceptionally poor at it. The field of behavioral economics studies this phenomenon extensively. Humans suffer from a cognitive bias known as present bias.
Present bias. Meaning we like stuff now.
Right. We inherently prioritize immediate gratification and current consumption over long-term abstract security.
I mean, if a financial planner sits you down and says, you need to automatically transfer $500 out of your checking account every month into an S&P 500 index fund, you might have the best intentions.
Sure.
You might even set up the auto draft. But in reality, 3 months later, the transmission on the car blows out. Or you decide the family desperately needs a vacation to Florida. Or you just want a nicer television.
Something always comes up.
Yeah, when voluntary saving goes head-to-head with immediate consumption, consumption almost always wins. You pause the investment contribution.
This is where the structure of the mortgage performs its most powerful, subtle psychological trick. It introduces the mechanism of forced savings.
Forced savings?
Yes. A mortgage disguises a massive, long-term wealth accumulation plan as a non-negotiable monthly utility bill.
Because the consequences of failure are asymmetrical. Like, if you stop funding your index fund, nothing immediate happens. Your future self is slightly poorer, but your life today doesn't change.
Right.
If you stop paying the mortgage, men with badges show up and take your shelter away.
Exactly. The consequence of default is so severe, so viscerally threatening, that the mortgage payment is elevated to the absolute highest priority in the household budget.
People will cut back on groceries, they will skip vacations, they will sell their cars before they miss a mortgage payment.
And if we remember the amortization schedule we discussed earlier,
Okay.
even though it is heavily front-loaded with interest, every single month, a small, slowly growing portion of that payment actively reduces the principal debt. Every single month, regardless of your personal motivation, regardless of your self-discipline, regardless of what the stock market is doing, a portion of your wealth is being systematically captured and locked into the equity of the home.
It is an automated wealth trap. You are building your net worth just by avoiding the pain of eviction.
The resulting wealth generated by this psychological mechanism is staggering. If you look at Federal Reserve data on consumer finances, primary residences account for a massive, disproportionate share of middle-income net worth in the United States.
So it's basically their retirement plan.
For much of a person's working life, the equity locked inside their home frequently dwarfs the balances in their actual dedicated retirement accounts, like 401ks or IRAs. It serves as the bedrock of middle-class wealth, simply because it forces the discipline that human nature naturally lacks.
Okay, I need to pump the brakes here.
What's wrong?
We are pretty deep into this, and we are painting a picture of a flawless utopian financial product. It builds the suburbs, it tricks us into saving money, it defeats inflation.
It sounds great.
But anyone who has lived through the last 20 years knows that real estate is not a guaranteed risk-free path to riches. Real estate has ruined millions of lives. It has bankrupted families.
That is very true.
If this is such a brilliant, government-backed forced savings tool, how do people lose everything in real estate? Let's get into the counter-arguments.
The danger of real estate, the reason it could be so catastrophically destructive, comes down to a single financial concept.
Which is?
Leverage.
Leverage, using borrowed money to multiply your potential returns.
Think of leverage like a powerful magnifying glass. In the right conditions, it can focus sunlight to start a fire and keep you warm. But it could just as easily burn your house down.
Okay, let's play this out.
Let's look at the mechanics of leverage using the data from our earlier scenario. You buy a $400,000 home, you put down 20%, which is $80,000 of your own money. You borrow the remaining $320,000 from the bank. The key here is that you now control a $400,000 appreciating asset, but you only have $80,000 of your own capital at risk.
Okay, let's say the local market is booming. A major tech company opens a headquarters nearby. Over a few years, the value of my home rises by 25%.
A 25% increase on a $400,000 asset means the home is now worth $500,000. Your paper gain is $100,000.
Nice.
And here is where the magnifying glass of leverage creates a disproportionate outcome. You did not invest $400,000 out of pocket to get that return. You only invested your $80,000 down payment.
So my $80,000 initial investment just generated a $100,000 profit.
If we ignore the transaction costs of selling for a moment, you just generated a 125% return on your initial equity, even though the underlying asset itself only experienced a 25% bump.
Because the leverage multiplied my return.
Yes. This specific dynamic is why people get incredibly wealthy in real estate during bull markets.
But the magnifying glass works in both directions. The dark side of leverage is what happens when the market turns against you.
It accelerates losses just as violently as it accelerates gains. Let's reverse the thought experiment. You buy the $400,000 home with $80,000 down, but instead of a tech company moving in, the largest employer in town goes bankrupt.
Oh, man.
The local economy stumbles and property values drop by 20%.
A 20% drop on a $400,000 house is an $80,000 loss. The market value of the home is now $320,000.
Which happens to be the exact amount of money you owe the bank. The bank's loan hasn't changed. Therefore, your entire $80,000 initial equity, your life savings, is completely wiped out.
Oh, God.
The asset only dropped 20%, but you lost 100% of your investment. You are effectively at zero.
And if the market drops further, say 25%, now the house is worth less than the loan. I owe $320,000, but I can only sell the house for $300,000.
You are trapped. You are underwater.
This exact mechanism is what triggered the 2008 global financial crisis, isn't it?
2008 was the perfect storm of violent leverage reversals. But But it is crucial to understand that it wasn't the traditional 30-year fixed-rate mortgage that caused the crash.
Sure wasn't.
No, the crisis was caused by a systemic perversion of lending standards. For years leading up to the collapse, Wall Street and mortgage lenders aggressively abandoned the strict underwriting rules that historically made mortgages safe.
Right.
They increasingly approved mortgages requiring little to no verification of income, the infamous NINJ loans. No income, no job, no assets.
NINJA loans.
Wow. They allowed people to buy homes with 0% down payments, which meant borrowers had absolutely no equity cushion to absorb even a minor drop in prices.
And crucially, they weren't pushing the 30-year fixed product. They were aggressively pushing adjustable rate mortgages, or ARMs.
Yes. These poorly structured ARM loans featured artificially low introductory teaser rates. They looked incredibly affordable in year 1 or year 2.
To suck people in.
Exactly. But the contracts were designed so that the interest rate would automatically reset much higher in year 3 or year 5, tying the payment to broader economic interest rates.
So people knew the rates would go up. Why did they do it?
Both the lenders and the borrowers operated under the collective delusion that housing prices would simply never fall on a national level. The assumption was that before the teaser rate expired and the massive new payment kicked in, the borrower could simply refinance the loan or sell the house at a profit.
It was a game of musical chairs. And then prices stopped rising. The music stopped.
When the housing market finally plateaued and began to decline, the leverage violently reversed. Millions of homeowners instantly found themselves underwater. Because they owed more than the house was worth, they couldn't refinance into a safe fixed rate.
And they couldn't sell the house without bringing cash to the closing table, which they didn't have.
And when the calendar hit year 3, their adjustable rates reset. Their monthly payments skyrocketed to levels they couldn't possibly afford. Foreclosure rates surged, the mortgage-backed securities built on those loans collapsed, and it triggered the worst global financial crisis since the Great Depression.
The ultimate lesson of 2008 wasn't that mortgages are inherently evil. The lesson was that poorly structured mortgages, combined with highly leveraged speculation, are absolutely devastating.
Spot on.
I want to expand on that difference between fixed rate and adjustable rate mortgages, because looking at the global landscape highlights something uniquely American about this entire financial trick.
The defining characteristic of a fixed-rate mortgage is that it locks your interest rate for the entire 30-year lifespan of the loan. Predictability is its greatest virtue.
So you know exactly what you're paying.
Right. If national inflation spikes to 9% and the cost of borrowing goes through the roof for everyone else, your mortgage rate stays locked at 3%. The bank simply has to eat the loss.
Right.
An adjustable rate mortgage entirely shifts that risk dynamic. It typically begins with a lower introductory rate to entice the buyer, but it periodically resets based on prevailing central bank market conditions.
So if the Federal Reserve raises interest rates to fight inflation, my ARM resets and my monthly housing payment might suddenly jump by hundreds or even thousands of dollars. My personal budget is held hostage by macroeconomic policy.
Exactly. When interest rates remain low and stable, ARMs can save you money. But when rates rise, your household budget is directly and violently exposed to the macroeconomy.
It sounds incredibly stressful.
What is truly fascinating from an international perspective is that the 30-year fixed-rate mortgage is essentially an American anomaly.
Wait, really?
Yeah, it exists here almost exclusively because of the heavy government backing and the secondary market created by Fannie Mae and Freddie Mac. Our system essentially takes the interest rate risk off the shoulders of the individual family and shifts it on to institutional investors in the capital markets.
Wait, so in other developed nations, the homeowner just carries that massive risk?
In many European countries, the UK, Australia, the 30-year fixed mortgage simply does not exist. It isn't an option.
What do they do?
Mortgage rates in those countries typically reset every 2, 3, or 5 years. Homeowners in those nations are totally exposed to central bank policy changes.
Oh, man.
If the European Central Bank or the Bank of England hikes rates to cool the economy, millions of families have to immediately cut back on groceries, cancel vacations, and tighten their belts to afford their newly adjusted, higher mortgage payments.
The American 30-year fixed system uniquely insulates the household from that specific monetary shock.
Yes.
Okay, let's pivot to another major counter-argument. The classic dinner party debate. You sit down with friends, someone mentions they're saving up to buy a house, and invariably someone else at the table chimes in and says, "Why would you buy? Renting is so much cheaper. You just pay for shelter, avoid all the maintenance headaches, and invest the difference in the stock market.
The old rent versus buy debate.
Let me play the advocate for the renter here. In a lot of high cost of living cities, isn't renting mathematically smarter for a lot of people?
It absolutely can be. The famous ubiquitous cultural statement that renting is throwing money away is mathematically inaccurate,
Oh.
and it fundamentally misunderstands the massive hidden costs of property ownership.
Let's break down why that phrase is a myth. Because culturally, we are conditioned to view rent as a total waste.
People assume rent is a pure consumption expense, like money lit on fire, while a mortgage payment is pure wealth accumulation. But owning a home is packed with severe, unrecoverable costs that are mathematically equivalent to rent.
What kind of costs?
When you own a home, you are paying property taxes every single year. That money is gone. You are paying for maintenance, a new roof every 20 years, an HVAC system, plumbing repairs. That money is gone.
Right.
You pay homeowners insurance. You pay interest to the bank.
We already established earlier that the interest alone can cost hundreds of thousands of dollars over the life of the loan. That is money you never see again.
Furthermore, you pay massive closing costs when you buy and sell the property. Agent commissions, title fees, origination fees. These can easily eat up 6 to 8% of the total value of the home in a single transaction.
That's a huge chunk of equity just wiped out.
And perhaps the most overlooked cost is the opportunity cost on your down payment. If you tie up $80,000 in home equity, that is $80,000. That is not sitting in an S&P 500 index fund compounding at 8 or 9% a year.
So if owning is packed with all these unrecoverable costs, when does the math actually flip? When does buying a house actually beat renting and investing the difference?
The mathematically superior choice depends strictly on 3 variables: your time horizon, your geographic mobility, and your specific local market conditions.
Write that down for me.
Buying only wins the math equation if you stay in the property long enough to amortize those massive transaction costs over many years, and long enough to reach that 15-year tipping point we discussed, where you finally enter the aggressive principal-paying phase of the loan.
Ah, so you have to stay put.
If you buy a house, pay all the closing costs, pay the heavily front-loaded interest, and then move 3 or 4 years later for a new job, the transaction costs will almost guarantee that you lost money compared to renting a comparable property.
Okay, so the entire trick hinges on time. If you commit to the timeline, stay put, and let inflation and amortization do their work, the trick works. So let's look at the macro level. What happens to the money once a buyer decides to take the plunge, commits to the timeline, and locks in that 30-year fixed payment? Where does my $1,919 actually end up after I click pay on my bank's portal? Let's zoom out to the bigger picture.
This is where we trace the fascinating economic loop that connects your kitchen table on Main Street directly to the trading floors of Wall Street.
Okay.
We mentioned earlier that local banks sell these loans to Fannie Mae to get their liquid cash back. But Fannie Mae doesn't just sit on $13 trillion of mortgages. They are a conduit, not a vault.
Right, they have to fund that infinite liquidity somehow. Where do they get the cash?
They get it from the global capital markets. Fannie Mae takes thousands of individual mortgages from all over the country, a loan from a teacher in Ohio, a loan from a nurse in Texas, a loan from an accountant in California.
And groups them together.
Right. They pull these thousands of geographically diverse loans together, blending them into a single massive financial product. This product is called a mortgage-backed security, or an MBS.
Think of it like a giant financial blender. You throw thousands of individual mortgages in, hit puree, and pour out shares of the resulting smoothie.
A very apt analogy. They then take these mortgage-backed securities, these shares of the smoothie, and sell them to investors on the global secondary market.
But who on earth is buying a pool of thousands of random American mortgages?
Institutional investors who are desperate for extremely predictable, safe, long-term cash flow. Specifically, we're talking about massive pension funds, life insurance companies, and sovereign wealth funds.
Wait, let me connect these dots. When I send my mortgage check to the online servicer every month,
Let's trace the complete cycle. Everyday workers, teachers, police officers, corporate employees, they save money out of their paychecks for their retirement pensions. The pension fund managers on Wall Street take those billions in retirement savings and need a safe place to invest it to generate a yield. They use that money to buy mortgage-backed securities.
oh my God.
Meanwhile, homeowners across the country make their monthly mortgage payments. Those payments flow up from the local bank, through the servicer, into the mortgage-backed security and are distributed as yield to the pension fund. That yield is what generates the monthly retirement income for future retirees.
My mind is completely blown right now. The debt I took on to buy my house is literally funding the monthly pension check of a retired firefighter halfway across the country.
It is an entirely closed, interconnected loop. Housing and retirement, the two pillars of American financial security, are permanently bound together through the capital markets.
It's all connected.
The entire system relies on the American homeowner waking up on the first of every month, going to work, and paying their mortgage bill to fund the broader financial ecosystem.
Which brings us to the ultimate macro player in this entire ecosystem, the conductor of the orchestra, the Federal Reserve. How does national monetary policy out of Washington, D.C. impact this highly localized loop of me paying for my three-bedroom house?
Well, it is important to clarify that the Federal Reserve doesn't actually sit in a room and set the 30-year mortgage rate directly. They don't dictate the price to the banks.
And what do?
What the Fed controls is the federal funds rate, the ultra-short-term rate banks charge each other. But moving the federal funds rate influences the yield on the 10-year Treasury bond. And if you look at a historical chart, the 30-year fixed mortgage rate tracks the yield of the 10-year Treasury bond almost identically, usually with a standard premium layered on top.
Okay, I see.
Because of this massive $13 trillion market we just described, housing has become the primary transmission mechanism for U.S. monetary policy.
Transmission mechanism, meaning housing is the physical steering wheel the Fed uses to drive the entire American economy.
Exactly. Let's detail the mechanics of how this economic steering actually works in practice. Suppose inflation is running too hot. Prices are spiraling. The Fed decides it needs to slow the economy down to cool inflation.
So they raise the federal funds rate.
Consequently, the 10-year Treasury yield goes up, and mortgage rates immediately increase. That means the monthly payment on our theoretical $400,000 house jumps from $1,900 to, say, $2,600.
Which instantly drops affordability through the floor for the average buyer.
Affordability collapses. Because families can no longer afford the monthly payment, demand for homes dries up. Houses sit on the market longer.
Which means less building.
Right. Because demand slows, home builders pull back and stop construction. They lay off construction workers, plumbers, and electricians. At the same time, existing home prices cool off or even drop.
And that affects people who already own their homes.
Yes. This triggers a psychological phenomenon known as the wealth effect. Homeowners check Zillow, see their equity shrinking, feel less wealthy, and consequently stop spending discretionary income.
They don't buy the new boat, they don't remodel the kitchen, they don't eat out at restaurants as often.
The entire macroeconomic engine decelerates, all triggered by manipulating the cost of the monthly mortgage payment.
And the reverse is true when they want to stimulate the economy out of a recession.
Precisely. When the Fed cuts rates, borrowing gets incredibly cheap. Not only do new buyers flood the market, sparking construction and job growth, but millions of existing homeowners rush to refinance their older, higher-rate mortgages.
Suddenly, a family's payment drops by $400 or $500 a month.
That is newly freed up cash flow. They take that extra $400 and spend it in the broader economy on goods and services. Housing activity accelerates, consumer spending spikes, and the economy roars back to life.
The mortgage is the primary lever the government pulls to speed up or slow down the American economy.
It is the biggest lever they have.
It is incredible to synthesize the massive, almost incomprehensible scale of this instrument. We started this hour by talking about a single family trying to buy a single starter house, and we end up at the steering wheel of the global economy.
It escalates quickly.
As we wrap up this deep dive, when you step back and look at the 30-year fixed-rate mortgage over the span of the last century, you really have to marvel at the sheer elegance and simplicity of the ultimate outcome. It is a tool that allows ordinary working-class families to purchase tomorrow's shelter using today's limited savings and repaying the debt gradually through decades of future inflated income.
It represents a profound historical shift in human economics. Before this tool was invented and institutionalized, property wealth and land ownership were almost exclusively reserved for the rich.
Just the elite.
It was for the aristocracy or for those who already had enough hoarded capital to afford massive cash down payments. After its introduction, the system was aggressively democratized.
Anyone could get in.
Homeownership became accessible to public school teachers, factory floor workers, nurses, and immigrants. It single-handedly financed the creation of the American middle class by granting them access to a leveraged, appreciating asset.
Now, we want to be balanced here. We've explored the dark side, and we have to acknowledge it isn't a flawless system.
No, it's definitely not flawless.
It creates astronomical aggregate interest costs for the borrower. It fosters a cultural expectation that relies heavily on maintaining massive household debt. It ties workers to their jobs because they have to make the payment.
Yeah, like we said, 2008.
Exactly. As we saw so vividly in 2008, when the underlying lending standards are abused by Wall Street, the leverage inherent in the system can amplify localized financial distress into catastrophic global crises. But despite all of those glaring flaws, its positive historical impact on generating and transferring wealth across generations is absolutely undeniable.
If we summarize the core thesis of the data we've explored today, the final definition of the trick is quite elegant.
How would you define it?
The greatest financial trick ever invented wasn't simply getting people to borrow money. Banks and moneylenders have done that for thousands of years.
Right.
The trick was engineering a unique, systemic environment where time, inflation, forced disciplinary repayment, and asset ownership all work in tandem to turn a dreaded, stress-inducing monthly utility bill into one of history's most powerful, automated wealth-building machines.
Wow. So what does this all mean for the future? I want to leave you, the listener, with a final thought to mull over. If you are commuting or walking the dog, think about this extrapolation purely from the logic we've discussed today regarding inflation, time horizons, and mobility.
Okay, let's hear it.
We established that the math of the 30-year mortgage relies heavily on staying put. You have to stay in the house long enough to beat the massive transaction costs, and it relies on moderate, predictable inflation to slowly erode the weight of the debt over decades. But look at where the economy is heading right now. What happens to the next generation of home buyers if gig economy careers and remote work demand constant year-to-year geographic mobility?
That's a huge shift.
If people are moving every 3 years, they never reach that 15-year amortization tipping point. And what happens if inflation ceases to be a slow, predictable erosion and instead becomes highly volatile and erratic? Does the greatest financial trick of the 20th century still function for the nomadic, unpredictable lifestyle of the 21st century? Or will the next generation of home buyers look inside the magician's hat and realize it's finally empty? Think about it. We'll see you next time.